on mute, and then I will bow out when the time is right.
Okay, cool. Thanks for your help, man.
Of course, dude.
So I'm going to go full screen here, nice and large, and we'll start the recording from here. So welcome everybody to Clarity, how your real estate goals can overcome the coronavirus. I have worked really hard on this presentation, so I'm very excited to present all of this information to everybody today. And of course, afterwards, like I said, we'll open it up to the Q&A. So if you guys have any questions at all, feel free to, if you want to write them down or whatever you want to do, to put those questions out there once the time comes, and we will get to that after the presentation. So I'm going to try to keep the presentation as, you know, reasonably brief as possible, but there's a lot of information, and we'll try to make it fun. So let's go ahead and jump into it. So starting off with our PowerPoint here. So Clarity, presentation on the effects of coronavirus on real estate in South Florida and the rest of the United States. So I am a realtor in South Florida, so I'm an expert on the market here, but I follow real estate trends nationally, and so we're going to talk about that as well. And who, let's see, boom. Click the button and it moves. Cool. Who am I? I'm Jake Fletcher. I'm a real estate investor. Officially, I have one investment property. So I am a real estate investor. I'm a realtor with RE/MAX Advanced Realty, which is one of the top 10 brokerages in Miami-Dade. I am located in Miami, Florida, but I do real estate throughout Southeast Florida. My email and phone number are listed there as they are in the background on my screen, with my image and IG, and my YouTube channel, which is where I'll be putting a lot of updates here in the future. Once these things kind of develop with the whole coronavirus situation and all that, I'll be continually updating people on the information, on the data that's happening in the market. So that's who I am. Who I'm not. I'm not your professional money manager. I'm not your lawyer, your financial advisor. I'm not an economist. Even though I do love economics, I am by no means an economist. I'm not a policymaker, and I'm certainly not a psychic either. So good news, everyone. Business is still happening. Real estate is a consistently stable commodity which recovers quickly more often than not, and the industry is already adapting quickly to the new circumstances. Many buyers were already looking to buy and still need to. So that's a good sign for people. Also, some people are now in the market that weren't before. They might need to move. They might have lost their job, might need to care for a family member somewhere else in the country or else in their state. And there are sellers on the market that need to sell, especially if they are occupying the home. They might be a little bit apprehensive to letting people into their house. So they want to sell quick, get it over with, before things potentially get worse if they need to sell. The investors are getting their war chest ready. Interest rates are still very low. It's a great time to refinance, and it's a great time to cash in on your equity if that's the right move for you. So that means either selling your home or potentially doing a HELOC, home equity line of credit. Not telling you to use your home as an ATM, but it's option for certain people if that's the right move for you. And we're going to go over that. We're going to talk about what makes that the right move or not. What are we up against? It's a pandemic, of course, which is what we call a black swan event, or what economists call a black swan event, something that we can't predict. We had no idea it was going to happen. That's debatable, really, but we didn't know when it was going to happen. And there's a lot of uncertainty around it, that specifically as well as in general about the economy and other major factors. So we have a volatile stock market, historic mass employment by the millions, fears of a widespread recession, and things are changing by the hour. So how has the industry changed so far? Well, there's been a huge decrease in showings, and basically there has been no open houses. Instead of actual physical open houses, people have been doing virtual showings. Sellers are requiring more info up front to qualify people. Homes are going under contract pending the buyers seeing the house in inspection period, which means you'll see the house as a buyer, you'll see it virtually or in the virtual open house, put in an offer, once you go under contract, the contract is pending or contingent on the buyer actually getting into the house physically to see it, because we don't have smell technology yet for virtual showings or for videos, unlike Professor Farnsworth from the earlier slide. And anyone who's joining this later on, you'll be able to catch the full recording of this on my YouTube channel. There are also COVID-19 addendums right now, at least in Florida, from the Florida Association of Realtors. And there are also certain clauses that you see Winnie up there. She's I call her the legal mastermind broker. That was a kind of a side note that I left in there to talk about, to remind me. But basically, these addendums are to prepare for eventualities in the process of going under contract and selling or buying a home that might be affected by COVID-19. So they are essentially protecting the buyer or protecting the seller, giving them an out if there are COVID-19 related things that prevent either party from being able to proceed. So it's like a big contingency on based on COVID-19. A lot more info about that, but again, we got like 20, almost 30 slides or something. So I'm gonna kind of try to go quickly here. And of course, it's a huge topic that probably books will be written about later. But right now, I just want to give you guys as much facts without overloading you. So it's a fine line. So low inventory. We have a low inventory in most places in the country, but there's also a much smaller buyer pool, which means a higher MOI, months of inventory. So months of inventory means if no other listings came on the market now, how long would it take to sell what's currently listed for sale? So how many months that takes is called the MOI, the months of inventory. Between 1 to 6 is what we call a seller's market. That means that there's more buyers than there are sellers. There's low inventory and a lot of demand. 6 to 12 months is a normal healthy market, and then anything over 12 months is what we call buyer's market. It favors buyers because there's a lot of inventory and not as many buyers, so that tends to allow you to get better deals as a buyer. Lenders are making guidelines much stricter, and they are changing hourly, as we said. So if you're in the market, call your lender, make sure you still qualify if you were already looking to buy, because these guidelines are getting tighter and tighter and tighter by the minute. So deals are taking more time due to lenders being backed up. Banks are scrambling with stimulus lending added to their normal activities, and all the components of the industry adapting in real time to handle familiar activities under new circumstances. So banks are making appointments for their customers to wire money, for example. So before you could just walk in and wire some money, now you actually have to make appointments. So all these things, that's just one example of many that I couldn't even tell you because I don't work for a bank. But just having closed deals while coronavirus is going on, I know that for sure banks are super backed up and deals are just taking more time. So keep that in mind if you're in the market. Let's talk about Miami-Dade. So we have Mr. 305 there, and he's going to let us in on some info. Let me share this other screen with you guys here. Boom. So this is the brunt of the data here. Let me see if I can actually I'm gonna bring this over here and share it like this. Hopefully that's a little bit better of an aspect ratio. So what we've got going on, we're going to talk about single family homes, then we're going to talk about condos and townhomes over here. So I've broken it down into 3 price ranges: under 700,000, 700,000 to $1 million, and then 1 million plus. And then we have averages of the percentages of change. Okay. So the reason I broke up into price categories is because different price categories behave differently. They have different pools of buyers, different needs, and different lending requirements, all kinds of stuff. They're just very different. So it helps to look at them separately. And then you can kind of composite the information together. So what we've also done, we've got March 2017, March 2018, the percentage change between those. March 2019, the percentage change between 18 and 19. March 2020, percentage change between that. And then that's what we call year over year, right? When you compare March of 18 to March of 19 and so on and so forth, comparing those 2 months from a year apart, that's considered year over year, okay? So Looks like we got some chat. Let's see. Oh, we don't see the chart. Oh, let's see. My bad. Let's go. Make sure you guys see the chart. Ah, I see. I was still on screen too. You guys were looking at my Zoom background. How's that look? Let me know in the chat if that looks good. So, like I was saying, we got the different price ranges. You can see March. Then all of a sudden, we have April, right? Because COVID was first started taking seriously here in the United States between mid-March, all right? So now we're at mid-April. So there's a star here because this is up till yesterday is when I drew this data, the 17th. So we're really comparing just about half of April with these data points. So take them for a grain of sand because they are not a full set of data for the month. Same thing when we get to condos and townhomes as well. And we're gonna compare that year over year with April of 2019 over here, okay? So also take that with a grain of sand, remember, because April's not done. Now, side note, boom, go to my social media links, go to my YouTube channel and subscribe because, and that's right here, because I'll be doing continual updates to all this information as it comes along at the end of April. Few days into May is when the data will be out. I'll do another video by then and we'll have the full data from April. So main things that we want to take away here, and feel free to screenshot this because I feel like if I go over all of the data, this is going to be like a 2-hour video. Main thing I want to point out, we have active listings, new listings, number of sales, months of inventory, right? So we have March of 2020 to April of 2020, right? What we see here is we actually went down in months of inventory in 2 of the 3 price categories, which is very interesting. And it's backed up by what we see here. There's far less new listings, right? Now, why would there be less months of inventory if there's less new listings and fewer buyers? Because the deals that are closing in March, it takes 30 to 45 days to close a sale. So they were started in, February or even in late January. They went under contract, so they end up closing in March. So we actually see number of sales in the 700 to $1 million actually went up by 19, almost 20%. It went up in the $1 million plus. It went down number of sales a little bit under 700,000, which is the biggest amount of the market of closed sales. It actually decreased. Now, new listings we see here all negative, right? All negative in the amounts, right? Compare 1,400 to 1,700 year over year, 142 to 169, 225 to 285. Doesn't seem crazy, but it is statistically significant for an average of 18% reduction. Now, we also see that continued so far over here in April. It's maybe not scientific to just say double these numbers, but even if you doubled it and then gave it a little bit of extra, you're still looking at a bigger decrease in the new listings in April 2020 compared to March 2020. So we're seeing that trend continue, and we're also seeing the trend continue in number of sales, okay? And it's slowly showing up in that active number of listings as well. And don't pay any attention to the months of inventory there because that's just kind of crazy, 200+% increases months of inventory. We don't know what it's gonna be until it's over. But that data is there, so because the formula is there, and when I redo it later, it'll be there. So, but what we see here is we see the trend continues in a decrease in number of sales, decrease in number of new listings, okay? Now, let's look at the condos real quick, and I'll give you guys a second if you want to screenshot that page, this page, or you can always come back to the recording later, but go ahead and screenshot it if you want to see this data later on so that you have it. You can kind of dig into it a little bit if you want. This is for Miami-Dade. I don't know if I mentioned that. This is Miami-Dade and single family homes, as you see here. There isn't enough national data out yet to really make any meaningful conclusions. We'll talk about that in a second. Let's go to townhomes and condos. Again, gonna kind of go through it a little quicker, point out what we see here. Trend is also happening in new listings for townhomes and condos for an average of negative almost 25% new listings in condos and townhomes. We already had a good amount of months of inventory for condos and townhomes. You see here, it actually went down year over year because there was a huge oversupply in condos and townhomes in Miami-Dade. The under 700 actually stayed the same. The 700 to a million went up just a little bit, but it was already at 32, you know. And then over a million went down dramatically from 52 to 37, right? So we actually, again, the trend continued of less months of inventory, even though we have less new listings, and we had actually more sales, because remember, the sales were already happening, right? But we see a big number there, 91 versus 65 year over year for the million plus. That's a 40% increase. So that balanced out that average positive increase in number of sales. Whereas in the other two price ranges where the majority of the action's happening, as you can see, almost 1100 and then 50, you have -11 and then -7% change respectively. So we see those trends continuing. Go ahead and screenshot this page again. We see, if we look year over year for April, we also see the trend, similar trend continuing, decrease in new listings, decrease in number of sales. Again, incomplete data, take it with a grain of salt, right? We're gonna revisit this after April is over and we have the full set of data. But even if we double these numbers and we're generous, add on another 10, right? A number 10%, or whatever you wanna do. You know, you've got 1,089 for all of March 2020. Now halfway through April, you've only got 270, right? So let's say best case scenario, you're at 600 or even let's say 700, right? That's still, man, you know, over 30% decrease in the number of closed sales for condos under 700,000, which, as you can see, is the vast majority. 13,000 active listings there. The active listings still at 12,600. Cool. So I don't want to bore anyone to tears with data. I love digging through the data, but here it is. So screenshot it. And that way, if you want to dig through it, you can as well. We're going to get back to the presentation. So let me know in the chat if you guys see the pit bull picture there, Mr. 305. Just press how about type in a 1 in the chat if you see Mr. 305 there. Perfect. Thank you, Steven. And let's keep it moving. So as we said, data for the United States, not enough reliable data out yet to draw meaningful conclusions. Subscribe to my YouTube channel, youtube.com/c/Jake Fletcher for those updates. While you're there subscribing, check out some of my other videos. I already did another coronavirus video at the beginning of March, and it's good information. So check it out. Mid-March, I believe, actually, was when that came, when I did the, oh no, it was, I really said at the beginning of April. Sorry about that. Who even knows about dates anymore when you're in quarantine? So March home sales will be available by the National Association of Realtors, that's who NAR is, on April 21st, and Q1 Metro home price statistics are going to be made available on May 12th. So you can see that's when I will get the data from NAR. And then of course I got to make a video and stuff. So it'll be interesting to see those national statistics after over a full month of coronavirus. 2.9 million people have requested mortgage forbearance, which means not paying your mortgage for 3 to 12 months, depending on your situation in your bank and what they allow. They might be getting screwed, those people, because what a lot of people don't realize going into those mortgage forbearances is that you're not just forgiving your mortgage. The banks aren't just going to sit there and say, oh yeah, you can just not pay your mortgage for however long you need to. It's all good, you know? No, you're going to have to pay that money back. And in almost all cases, it's in the form of a lump sum at the end of the term. So if you can't pay 3 months worth of mortgage payments in 3 months from now, maybe don't take a mortgage forbearance. So this could be a catastrophe for the mortgage market and people's credit scores. So the CARES Act, part of it was to protect credit for April, May, and June, right? Those 3 months guaranteed, right? But what happens after that? So you'll need to talk to loss mitigation at your bank, which are very hard to get in touch with. But to get a hold of them, you'll need to prove hardship. And you'll also be you'll have to be at least 30 days late by that point, which means a minimum 100-point credit score drop. That means you're not going to qualify for a lot of stuff. Okay, so loss mitigation determines what to do with you after you've already missed payments and the bank is hemorrhaging money. So you have less leverage with your bank and they're hemorrhaging money, they're getting desperate, and you're late by at least 30 days, your credit scores drop, you already missed payments and you owe them a bunch of money and you're gonna have to pay it in one lump sum. So they've got you by, you know, the hairs of your chin. I don't know if I used that analogy correctly, I don't know, but they've got you, right, by the you know what I'm trying to say. You're going to have to most likely liquidate assets if you have other assets to pay them back. They're going to force you to do that because they've got all the leverage. You're not going to be able to refinance and take advantage of low mortgage rates because you won't qualify anymore because your credit score is going to be at least 100 points lower. If you were at a 750 before, you're at a 650 now, right? So not good, no bueno. So continuing here with the data, we have some data from Realtor.com and Zillow, even though everyone knows not to take Zestimates seriously, because as you can see there, Zillow CEO Spencer sold his home for much less than Zestimate. I love showing this to people, especially clients and potential clients. He ended up selling his house for like $1 million, and the Zestimate was for like 1.75 million. So that shows you how accurate Zestimates are right there. But Zillow is pretty decent at collecting consumer data since they're such a behemoth of the online real estate industry, and online is a good way to collect data from people. So what we have here, and they also own Realtor.com. So you see, we got a little Zillow article, we got a Realtor.com. So Realtor.com, anytime you see that, it's basically Zillow Group. So what we see is median list price actually rose in the month of March 2020 to 320,000, and that was a 4% increase year over year. So that's good news, right? But and also days on market went down 60 to 60 days, which is a 6% decrease year over year. So both good things, right? But here's the trouble spot: 1,024,000 and change active listings, which was a 16% decrease year over year, which usually we're getting ready for the spring market. People are getting ready to sell their homes, to move for the summer because the kids are out of school now and it's time to retire or whatever it is. The summer is the time to move. So now's the time to put your home on the market. Usually we see in some cities a 50% increase in active listings, you know, maybe on average around 20-25% in most cities. So the fact that it's a 16% decrease in March is a big, big sign. Let's go to the next one. Coronavirus impact new listings fall sharply, right? Continuing this this line of thinking here. This is from Zillow, an article from them. Newly listed homes were down 27.1% from a year ago in the first week of April. So this is the first week of April, not the whole of March. And we're talking about newly listed homes. So new listings versus total number of active listings. So two different metrics, important to make that known. Down 27.1% in the first week of April. Also, that article goes later on to say, you can see here in the red, total active listings down 8.3% year over year as of April 5th. So that's not as bad as that 16%, right? But still, even April, like this is the spring home market. We're supposed to be seeing these active listings going through the roof right now, and it's still down a statistically significant amount. So the United States continued. When talking about real estate nationally, we must understand that real estate is a hyper-local industry and local markets are all super, super different. So anytime you hear someone speaking in broad, general, carte blanche terms about the United States real estate industry, understand to take that for a grain of sand. Tip of advice from me to you, because really real estate is one of the most hyper-local industries that exists. For example, even in the same city or metro area, you can have very different markets and market conditions. Like here in Miami, we have Brickell, where we have a super buyer's market, way more inventory of condos than buyers, and people are getting huge discounts on those. Compared to Coconut Grove, where prices are inflated because there's more people wanting to move there than there are homes available to buy. And you end up with a seller's market and people being able to bump up the prices. So in addition to a seemingly limitless economic and societal factors, there are many factors that play into how each hyperlocal market's behaving, including but not limited to number of active listings, number of new listings, months of inventory, average sale price, list price to sale price ratio, which means how much it was listed for in relation to how much it sold for. So if it was 100,000 and it sold for 90, it sold for 90% of the list price, and also days on market, like we said. So as of now, here's what we're seeing in a few of the country's largest metro markets, based on interviews from top brokers in each cities. So in Atlanta, there's low inventory, but there's a healthy buyer pool. So it's more of a temporary slowdown there as of now than a great recession-like slump. Property viewings are down as they are everywhere, but the market is still moving. Boston, prices are only coming down slightly. There's fewer bidding wars, less competition, but May prove fleeting despite major uncertainty, and buyers willing to navigate virtual home showings have a bit more leverage than in the past. We're going to talk about that in a second. And basically Boston's a hot market, so it's even less of a temporary slowdown than Atlanta, and prices are only going down slightly. Chicago, where Atlanta's also, by the way, a kind of more of a linear market, where Boston's more of a cyclical market, which means Atlanta's prices are going to not change as much on average than Boston's will. Chicago, also a cyclical market. Many listings have been put on hold while shelter-in-place orders are in effect. COVID-19 has created a temporary buyer's market, but no telling how long it will last. So again, buyer's market means 12 months or more of inventory. Detroit, as we know, is a big, hard-hit city by COVID. Still possible to buy and sell, but the market's essentially on pause with few new homes coming onto the market. Los Angeles, real estate was deemed essential under the city and county's safer at home order, but is essentially on pause due to strict social distancing guidelines. And the normal roaring spring market, as I've been talking about here, is been reduced to a simmer. So it's not clear yet if prices will be affected. We know, LA is usually a city where people are, there's multiple bids for every property and they're all over list price, and you just can't even buy a home there because, they get snatched up so quickly. Now, keeping it moving to the next slide. Will the housing market collapse like it did in 2008, Jake? Well, I don't have a crystal ball, but like everyone, I do have an opinion and I do follow these things closely. So here are my opinions. It all depends on how much the overall economy is affected and how long the virus has businesses shut down. To get a loan, banks now are going to likely want a lot more stuff. So they're going to want more money down. They're going to want you to have a higher credit score, a lower debt to income ratio, which means, your income in relation to how much your monthly expenses are. So if your monthly expenses are $500 and your income is $1,000, you have a 50% DTI, just to use easy numbers. They're going to have more stringent standards, they already do, of VOE, which is verification of income, 3 days, and even I've heard in some cases 1 day. So verification of employment is when you're closing a deal. They're going to now call 3 days or even up to 1 day before the closing to call your boss and say, hey, does Jimmy still work there? Right? Whereas before it was 2 weeks, right? Lower debt to income, we just said that, but 50 as the max. Before there were some loans that would go up to 55. Different loan products are going to be different, but you're going to have lower debt to income ratio. So less debt and expenses compared to how much income you have. So a HELOC, which is a home equity line of credit, now requires a 720 credit score, up from 660. This is coming from Bank of America and Chase, and probably other banks will follow with that. So that means that when people have equity in their house, they can take out some of that equity and use it for other things, put the kids through college, buy other investment properties, start a business, whatever it is that they need to do. You have equity in your house, you usually can draw on that equity. You're kind of betting on yourself that you'll be able to pay it back. It comes with an interest rate, of course. And then you're able to free up some of that capital in your house for other things. So that's a HELOC. So in order to get one of those now, you have to have a much higher credit score. Self-employment numbers, if you're self-employed and you're unable to show bank statements now, you will be using your numbers based on your tax returns, which is your qualifying income, and they'll be reducing it by 20% to give them even more wiggle room. So if you're not a regular W-2 employee, you better have good tax returns and plenty of room to spare. Slightly higher interest rate due to demand for cheap money, everything that's going on, and looming foreclosures. So basically, since this all has started, lenders, the finance rates for financing were already so low. So a lot of people were trying to refinance, a lot of people were trying to buy. So they were already really busy with that. And then all the coronavirus came tumbling down. And that's another reason why everything's super backed up, as we mentioned before. And also they're looking to the future at a potential foreclosure crisis, we could say, but hopefully not. We'll see how it goes, but they're looking at potentially a lot of people not being able to pay their mortgages coming up. So for investors, this is going to affect them because rental income now can only be used if you have a FICO score, credit score of over 700, and you can document 6 months of reserves for each finance property in which rental income is being used to qualify. So if not, they deduct those expenses from your income and you'll qualify with whatever's left over. So if you're an investor, you're trying to buy more properties, you better have over 700 credit score. And for every property that's financed currently, you need to have 6 months of reserves, which is a lot of money and can get very expensive for investors and make investing very difficult. That information is coming from JP Morgan, right? Again, this is also very new that not all the banks have their information really kind of publicly out there yet, but that was what I was able to find regarding investors for JP Morgan, which is a big lender. So what a few of the big banks are doing now may soon be copied by the smaller banks, or the smaller banks could be even more strict, right? So that's why this is even relevant. What does this all even mean, dude? So what we should expect to see in the future includes, but certainly not limited to, less qualified buyers in the buyer pool. My guess is about 20 to 30% for the near future because of the new and constantly changing / tougher loan requirements. Newly unemployed people who were actively looking, and fears of coronavirus transmission. People don't want to be out looking for homes if they think they're going to get coronavirus while they're doing it. This means that there will be less competitions for qualified buyers, but if you're one of those buyers, the competition will be more qualified as well. Okay, so this will also mean less demand, which usually results in reduced prices, but refer back to the fact that real estate is hyper local. So all markets are different. So it does not necessarily mean that less demand is going to result in reduced prices. And of course, there's other factors that affect that. So it could result in reduced prices or sellers having to accept terms that they wouldn't have before. So there also potentially will be an uptick in short sales and foreclosures later if a large portion of homeowners are unable to pay their mortgages. So there's probably going to be more help from the Fed as well as some above average inflation. Depending on how severe, this could result in a long-term change in the amount of people who can afford to purchase and an increase in the amount of renters. So that's interesting. If a total of 7 million households, this is just an example. Right now, we said it was 2.9 million requested forbearance. If it gets up to 7 million, that's what this example is using as a number. So suppose 7 million households request forbearance and people sell or refinance on average every 7 years. Then next year, we could see 1/7 of those people out of the market, which is 1 million people, 1 million less people involved in real estate transactions. And a little less than 6 million real estate transactions happened in 2018, which means it would be 16% less in that instance, just because of mortgage forbearance. Remember, this is just talking about the households that are forbearing, not being able to participate because their credit score is now lower, and banks are like, no, we're not lending you any money. So don't take a mortgage forbearance unless you absolutely have to, okay, is the moral of the story here, okay? So that's 16%, rough math, but right off the top, just from the forbearances, that's a huge cut to the buyer pool. Okay, Jake, but tell me what I really want to know. Are prices going down or what? Probably with less able buyers, investment properties could get the hardest if tenants are not paying rent because they use the pro formas of those investment properties to determine their values. If the tenants aren't paying rent, then the pro formas aren't going to be looking so hot. And the pro formas are basically the balance sheets of the rental properties, how much money they're making. So if you have 3 units and they're all 1,000 each, you're making 3,000 a month net or gross, and then all of a sudden 2 of your tenants can't pay. Now you're only making 1,000 gross. So that's going to affect the value of your property because tenants, their leases are going to have to last until they're over. You can't just end their lease as soon as you become the owner. The crisis is going to also affect greatly those who are not paying their mortgage, as we talked about. They're going if they've lost their job as well, and then find no other way to restructure their payments after the forbearance period. The severity of this depends on how long this lasts, assistance from the Fed, and how much buyer activity there is at the time when any homeowner in default or that needs a short sale or foreclose, when they need to sell. So at that time, when it's time for them to short sale or whatever it is, how much buyer activity is also going to depend on just how bad that situation gets with people having to reduce their prices and stuff like that. So only do a mortgage forbearance. Again, I'm just really want to caution people and get this out there. If you're a homeowner, only do a mortgage forbearance if you absolutely must, since they're usually due as a lump sum at the end of the forbearance period, which at this point, the max is 12 months. The CARES Act stipulates for 3. All these things change though, right? So should I wait to sell? Well, we're at the beginning of a downward market. Some might say a downward spiraling market. So, you know, if you are thinking of selling, right now we're already starting from a baseline of near all-time highs, like lifetime of history of the world. So if you are thinking about selling, you're still pretty close to the top. And if these prices are going to be going down, now would be a good time to sell. So yeah, no, you don't want to wait. If you lost your job or you can't pay for your mortgage payments and do a mortgage forbearance, it will be due at the end of the forbearance period, as I keep saying, in one full lump sum, or else you risk foreclosure, right? Now's a good time for this person to cash out their equity, especially if they bought between 08 and 2013, because they bought at a low and now we're at a high and they have a ton of equity, in a lot of cases, 100% or more. So it might be time to maybe rent for a while, use that cash to support yourself while finding a new job or starting a business. So if you've thought about starting a new business, maybe now is the time to go ahead and take that leap. You sell your house, say you sell it for 400,000, your business, you put, however much you need to put into that, you have the rest to help you subsist until you're able to make that business profitable or get some other money coming in on the side. And then you're renting in the meantime while you're building up that business, building up your future, right? A lot better than foreclosing on your house, right? Nobody, of course, wants to rent if they don't have to, if they're a homeowner and they're comfortable doing that, but that would be way better than foreclosing and not being able to get a mortgage for 7 years. So, okay, so should I wait to buy? Well, lenders, as we said, have upped their requirements big time. So check with the lender to see if you still qualify to buy. If you have cash or you have good income and credit, you're in an excellent position to get a deal on whatever you buy. If that's not you, you may have a tough time getting a house, or you may have to wait until you meet the new requirements from lenders if you currently do not meet those requirements, okay? So there's a lot of variables here. That's just a quick kind of run through. We're gonna talk about that a little bit more in a second, but basically it all comes back to make sure you got enough cash for down payment, make sure you keep your credit score good, and if you have good income and you're still employed, then congratulations, because you're in a good position. When should you be ready to invest? If you're an investor, lenders, as we said, have upped their requirements for investors too. So check with a lender to see if you still qualify to buy. The MCAI, the Mortgage Credit Availability Index, decreased by 16.1% in March, which means it's 16.1% harder for you to get a mortgage in the month of March than it was before. In general, for all types of loan products. For conventional, it was 24.2% harder. For government-backed loans like FHA, VA, or USDA, it was 6.6% harder. And jumbo loans are just grinding to a halt at 36, almost 37% harder to get a jumbo loan. So if you have cash or good income and credit, you're in an excellent position to get a deal. If that's not you, you may have a tough time getting a house, or you may have to wait until you meet the new requirements from lenders if you currently do not meet those requirements, okay? So similar to like what we said with buyers, investors are in a similar boat, but they have different objectives, but a lot of things still apply to them. So strategies to get ahead. So here's where we're starting to game plan. So how to make money at a time when there's a lot of uncertainty. Banks are making it harder for regular people without a ton of wealth and assets to buy real estate. Realize there are two very different general paths, okay? So if you think that the Fed will stop printing money and that prices will go down, and that prices will go down in the long term, basically we're looking at deflation, you want to hoard cash. You want to build up your cash stocks, maybe get a little mix of gold. If you're into cryptocurrency, get a little Bitcoin and just hodl, right? Hold on for dear life until that cash is worth more than it is today, because that's what deflation means. If you think that the Fed will keep printing money, seems like it might happen, to prop up the economy, prices will go up in the long term, basically an inflation scenario, then the only way to get ahead is to get into assets. So 3 different assets here. This is a whole nother book, but just want to give you guys a quick little insight into this. So an easy and safe investment for you is dollar cost average index funds on red days. So if you don't know what index funds are, they're kind of like stocks, but they group a whole bunch of companies together. So it kind of helps to mitigate any one company dropping a lot and the other ones are doing good. So it kind of balances it out a little better. They're a little safer than stocks. And you can dollar cost average them when the market is red. So check that out for more information, Google it or something. Another safe investment, my favorite, cash and get pre-approved to buy a wedge deal. So get that cash ready for that down payment for a wedge deal, basically, which means real estate that is priced under market value. So, and then you're going to hodl again. You're going to hold on for dear life. This is not a scenario in most cases where you're going to be looking to do flips. You're looking for properties that are undervalued. They have a lot of cosmetic repair needed and things like that. And you're going to buy them and you're going to turn them into a good investment for yourself for passive income as a long-term hold. Now, here's another aggressive strategy for investing into assets, and that is bounce back stocks, basically meaning once you believe that you're selling under market, ones that you believe are selling under market value. So like Tesla recently, and other companies that have stocks that are down because the rest of the stock market's down, but you think they're going to be going up. So stocks, REITs, real estate investment trusts, and real estate investment funds. You can also use that equity that you get from that aggressive strategy to build that equity and invest in good real estate deals, into wedge deals. So take that equity from the aggressive strategy, put it into a safer strategy. And there's no better hedge against inflation than the 30-year fixed mortgage, especially at today's interest rates. So that means that if you're going to pay cash for a house for $300,000, or you can buy that same $300,000 house for, let's say you get it for, let's just go conventional, right? You got $60,000 down and you're going to finance the rest. Then your $60,000 down plus your payments every month for 30 years is going to, even with interest, add up to less actual dollars than if you put that $300,000 down cash up front after 30 years of inflation. So 30 years of inflation on that $300,000 cash is going to be a lot more money than hedging that bet against 30 years of inflation, and you'll end up better off in the long run. If you want more information about that, go look up one of my favorite YouTube channels is a gentleman whose name is George Gammon, and it's Gammon, and he's got a lot of really good videos about economy and the economics, and about just all kinds of good stuff. So check him out. Strategies, how to get ahead continued. So we're going to look at first-time buyers, sellers, and investors. All right. Buyers, get pre-qualified and or pre-approved. Difference between those two: pre-approved is like the stamp on the paper, boom, you're approved. Pre-qualified is more like, yeah, you're qualified, So you're going to compile as much cash as you can for that down payment. Find an excellent realtor. Shop lenders, because you can shop different mortgage products. Different lenders can get you better deals than other ones. Look for off-market deals with your realtor, wedge deals like we talked about as well. Find a panic seller. This might sound kind of not great, but hey, there's a lot of people who need to sell, or there are people who are like freaking out and they're like, oh my God, I need to sell right now because my house is going to be worth half what it is now. So if you find a seller like that, you have a good opportunity of getting a good deal. Become familiar with the new tech that's being used for showing houses and for open houses. You'll just be a little bit ahead of the curve and ready for that. Be proactive about your search. And I would not recommend looking at land developments or commercial deals right now. First-time buyers, some similar stuff to buyers, but targeted towards first-time buyers, of course. Learn about the process first. The better informed you are, the better decisions and leg up you have on less informed first-time buyers. Stack your cash, borrow from your family, your Uncle Freddie, whoever it's got to be, whatever you have to do legally, of course, but understand that if you don't qualify right now or anytime soon, maybe you lost your job or you no longer meet those stringent requirements that we talked about, or you don't have enough cash, this period of time may be the best step for you, maybe to keep increasing your cash reserves and gaining assets so that you can afford later on to purchase a home or purchase real estate, and also continue learning to prep for when you're ready for that time. Get pre-approved and pre-qualified as well. Pre-qualification comes first, then pre-approval, or you can just get pre-approved if you're going to be buying soon, but it only lasts for a certain amount of time. Talk to your lender. Find an excellent realtor who is responsive, has attention to detail, cares, and is amicable, someone you get along with. That's a really crucial step, is finding a great realtor, because we are not all made the same. Find a good lender who's willing to guide you through the loan process. Some lenders just, you're another, statistic. Some lenders actually care, pick up your phone calls, talk to you, teach you about it, about the loan process, etc. Same thing goes for realtors as well. Off-market deals are great. Wedge deals, as we said, panic sellers, of course. Become familiar with the new tech, right? We already said that, and continue to be proactive. Sellers, you've already decided you're going to sell or you need to sell, so maybe consider refinancing to fund your purchase and rent your current home for passive income. Maybe a good way to hedge against the potential for an economic downturn in the future. So yeah, you're not necessarily selling, right? But if you're selling, that means you have an asset and you could use that asset to generate passive income for yourself. You might say, well, I don't want to be a landlord. You don't have to be a landlord. You don't have to manage your property yourself. There's lots of management companies out there that'll do it for you for a fee. And also, you want to act quickly if you're a seller. Like we said before, we're at the top of a downward spiraling market right now, and we're still at the baseline of all-time highs comparatively. So act quickly before those prices start to go down. Find a great listing agent who will optimize selling in the current market conditions. Don't just find any old agent or whoever, sent you a flyer last. Literally try to seek out a quality agent, somebody with a heavy online strategy and comprehension of how to sell houses online and how to do things in this new age. Has excellent photos of their properties, videos, drone photos and drone video sell a property 68% quicker as per a NAR statistic from 2018. 3D models of your house and walkthroughs, and find a listing agent who is accountable and has a good work ethic, because these are uncertain times. So you want somebody that you can trust and that you know is going to be working for you. Price it right the first time. So you and your agent need to price it right, because if you don't, then you lose the first 2 weeks of pricing it correctly, which is when the most activity is going to be on your listing. So competitive pricing beats the competition is what I always say. And now I'm adding to that, and it avoids getting caught in this downward spiral that I've been referencing. Listen to your realtors, not your emotions. Emotions get in the way of home sales during a normal market. So during a market like this, a very emotional time, it's very possible that your emotions might shoot yourself in the foot, right? Your realtor does not have the same emotions you have about your home. Their kids didn't grow up there. They didn't have their wedding in the backyard under the gazebo. So they don't have those emotions. They can look at it as a statistical transactional situation, deduce what is the proper thing to do to maximize your return. And you both have the same end goal and general common interest, because the more your realtor sells your house for, the more money your realtor makes. And of course, same thing goes for you. So you guys have the same mutual goals, right? So trust your realtor. They know what they're talking about, especially if you find a good one. Investors, prepare your war chest and get ready for battle. You got to be patient, all right? The time for the deals, like the super capital D deals, the craziest deals, are not here yet. So be patient. They're coming. I don't have a crystal ball, which I did, but I don't. And those deals, they are coming, I can tell you. So be patient. Leverage financing, even if you usually buy all cash. So I know in some investors that, oh no, I buy cash because, I just don't want to deal with financing and it's more of a headache. Okay, well, like the scenario we said before, if you're going to pay $300,000 cash for something versus $60,000, where then now you still have $240,000 left over to put into other assets and make more money, right? You put that $60,000 down, or whatever the amount is, and then you hedge your bet against inflation over time. Now you have more assets, etc., right? That's a better strategy for a market like this than just buying all cash. And trust me, it's worth the little bit of one-time headache of talking to a lender and setting up financing, I promise you. Especially if you have kids and you're thinking about how you're going to, what kind of portfolio of real estate and wealth you're creating for your generations coming after you. Consider liquidating some of your positions, especially ones with 100% or more equity, to use for more new positions. So if you have one single family home valued at $500,000, that equals 5 single family homes valued at $500,000 each that are discounted and could be worth, after all this is over, $600,000, right? So again, going off of that 20% of 500,000, right? You're looking at $100,000. You liquidate a $500,000 house, you have 5 sets of $100,000. You could go buy 5 $500,000 houses now and have quintuple the cash flow that you had before. That's, I think, a good idea. Call your realtor, let them know what you're looking for, and use their resources. So your realtor's not going to know what you're looking for unless you let them know. So let them know, reach out. Don't wait for them to call you. They might be busy with clients and not even know that you're looking to invest. Maybe you sold them, they sold you a house, and now you're looking into getting investing or whatever. Call your realtor. Don't wait for them to call you because, like I said, be proactive. Although a good realtor will call you first. Holler, shout out. Also, use your realtor's resources. We have a lot of connections to other realtors. We know when their market deals about to come on the market. We have access to people in other areas, things like that. So use our resources and talk to your realtor about those resources. If you are financing, talk to your lender to confirm the requirements and terms that you'll need to get approved for any deals that you're looking to do. Of course, we're looking for off-market deals, wedge deals, panic sellers, and people who need to sell. Become familiar with the new tech, like we said, be proactive, and also stay educated and up to date on a constantly changing market and all the requirements, not just for investors in terms of the banks, but also for tax purposes, because it's much more complicated from the IRS standpoint for investors. So make sure that you're staying on top of all that stuff as well, because it's also changing. Everything's changing. Stay away from land developments, commercial deals, including apartment buildings, right? So you might say, hey, apartment building sounds good. Well, if you got 20 units and then half of them are people not able to pay rent, not such a good investment versus a single family home where you can vet the people and confirm if they have a higher likelihood of being a stable tenant. Get ready to screenshot this, people. Here we go. The last slide before we open it up to Q&A, and screenshot. Boom. So contact me. Again, my name is Jake Fletcher. I'm not your financial advisor or your attorney, but I am your realtor, and I am a real estate investor. I am in a top 10 brokerage here in Miami. That is RE/MAX Advanced Realty. And I do all of Southeast Florida, the Tri-County area, Miami-Dade, Broward, and Palm Beach County. There's my number. That's my Instagram. That's my YouTube channel. Check it out and definitely watch some of my videos, subscribe, and comment. Let me know what you guys want to see next. And that's the end of the presentation. So I'll open it up for Q&A. I'm not sure if anybody has any questions or if anybody wants any clarification on anything. You can also type it into the chat box, or you can unmute yourself and just ask the question, or you can unmute and you can open your video. So feel free to ask any questions at this point, and I'll answer any questions that you might have. Let's see, I'll just wait a second if anybody's typing anything in. No questions. Okay. Well, I guess I must have answered all of you guys' questions then. So that's good. That means it was a successful presentation. And I want to thank you all for joining me. If you're looking for any real estate help here in South Florida or anywhere in the world, I can help you out because I have access to a global referral network of top agents all around the world. So no matter where you are in the world, I can help you out, especially if you're in Miami or Southeast Florida. I can absolutely for sure help you out and guarantee you'll be working with the best agent around. So follow me up, guys. Let me know what you think about this information. And thank you, Cindy. You're awesome too. And yeah, looking forward to the next one. Maybe we'll do this again in a couple weeks. I just want to make sure that people are informed about what's going on. So peace out, guys. Have a great weekend. Sell smart, buy bold, and stay safe out there. Wash your hands. I'll see you next time. Peace.